Welcome to our comprehensive guide on asset allocation strategies. In the world of investing, asset allocation is the process of dividing your investments among different asset categories, such as stocks, bonds, and cash. This approach helps manage risk and can significantly impact your portfolio's overall performance. Today, we'll explore the core principles behind asset allocation, why it matters, and how you can use different strategies to achieve your financial goal. Whether you're a beginner or an experienced investor, understanding asset allocation is essential for building a resilient investment portfolio. Let's dive in and start with the basics. Asset allocation refers to the way you distribute your investments across various asset classes. The main goal is to balance risk and reward by adjusting the percentage of each asset in your portfolio according to your risk tolerance, investment goals, and time horizon. For example, a younger investor might allocate more to stocks for growth, while someone nearing retirement may prefer bonds for stability. By spreading investments, you reduce the impact of any single asset's poor performance on your overall portfolio. This foundational concept is key to long-term investing success. You might wonder why asset allocation is so important. The answer lies in risk management. Different asset classes behave differently under various market conditions. By diversifying your investments, you can potentially reduce the overall volatility of your portfolio. Studies have shown that asset allocation decisions account for a significant portion of portfolio performance over time, even more than individual security selection. In short, a well-thought-out asset allocation strategy can help you weather market ups and downs and keep you on track toward your financial objectives. Let's break down the core asset classes. The three main categories are equities, stocks, fixed income bonds, and cash or cash equivalents. Equities offer growth potential but come with higher risk. Bonds provide income and stability, while cash offers liquidity and safety but usually lower returns. Some investors also include alternative assets like real estate, commodities, or even cryptocurrency. Understanding the characteristics of each asset class is crucial for building a balanced portfolio that matches your goals and risk tolerance. Stocks or equities represent ownership in a company. They are often considered the growth engine of a portfolio because they have the potential for higher returns over the long term. However, stocks are also more volatile and can experience significant price swings. Including stocks in your asset allocation can help your investments grow, especially if you have a longer time horizon and can tolerate short-term fluctuation. The proportion of stocks in your portfolio should reflect your comfort with risk and your financial goals. Bonds are debt instruments issued by governments or corporations. They are generally considered less risky than stocks and provide regular interest payments, making them a popular choice for investors seeking stability and income. Bonds can help cushion your portfolio during market downturns, but they typically offer lower returns compared to stocks. The right mix of bonds in your asset allocation depends on your need for income, your risk tolerance, and your investment timeline. Cash and cash equivalents, such as money market funds or short-term government securities, provide liquidity and safety. While these assets don't offer high returns, they are essential for meeting short-term needs and providing a buffer during market volatility. Having some cash in your portfolio allows you to take advantage of new opportunities or cover unexpected expenses without having to sell other investments at a loss. The amount of cash you hold should align with your financial situation and comfort level. Alternative assets include real estate, commodities, private equity, and even cryptocurrencies. These assets can offer diversification benefits because they often behave differently from traditional stocks and bonds. Including alternatives in your asset allocation can help reduce overall portfolio risk and potentially enhance returns. However, these assets may come with higher fees, less liquidity, and greater complexity. It's important to understand the risks and rewards before adding alternatives to your portfolio. Risk tolerance is your ability and willingness to endure fluctuations in the value of your investments. It's influenced by factors like your financial goals, investment timeline, and personal comfort with uncertainty. Understanding your risk tolerance is crucial when deciding on an asset allocation strategy. If you're risk-averse, you might prefer a higher allocation to bonds and cash. If you're comfortable with risk, you may lean toward more stocks. Assessing your risk tolerance honestly helps you build a portfolio you can stick with through market ups and downs. Your investment time horizon, the length of time you expect to hold your investments before needing the money, plays a big role in asset allocation. A longer time horizon allows you to take on more risk, as you have time to recover from market downturns. Shorter time horizons call for more conservative allocations, focusing on capital preservation. Matching your asset allocation to your time horizon helps ensure your investments are working for you when you need them most. For choosing an asset allocation strategy, it's important to define your financial goals. Are you saving for retirement, a home, or your child's education? Each goal may require a different approach to risk and return. Clear goals help you determine the right mix of assets and keep you focused during market fluctuations. By aligning your asset allocation with your objectives, you increase your chances of achieving what matters most to you. Strategic asset allocation is a long-term approach where you set target allocations for each asset class and periodically rebalance your portfolio to maintain those targets. This strategy is based on your risk tolerance, time horizon, and financial goals. It's a disciplined way to invest, helping you avoid emotional decisions during market swings. By sticking to your plan and rebalancing regularly, you can keep your portfolio aligned with your objective. Tactical asset allocation is a more active approach. Here, you make short-term adjustments to your asset mix based on market conditions or economic outlook. The goal is to take advantage of opportunities or avoid potential risks. While this strategy can potentially enhance returns, it also requires more time, research, and a willingness to accept higher risk. Tactical allocation is best suited for experienced investors who can monitor the markets closely. Dynamic asset allocation involves continuously adjusting your portfolio in response to changing market conditions. Unlike strategic or tactical approaches, dynamic allocation is more flexible and can shift significantly over time. This strategy aims to capitalize on trends and minimize losses during downturns. However, it requires constant monitoring and a deep understanding of the markets. Dynamic allocation is often used by professional fund managers or sophisticated investors. Core satellite approach combines a stable core portfolio, often made up of broad market index funds, with smaller, more specialized satellite investments. The core provides stability and diversification, while the satellites offer opportunities for higher returns or exposure to specific sectors. This strategy allows you to balance risk and reward, keeping your portfolio grounded while still pursuing growth. It's a popular method for investors who want both security and flexibility. Age-based asset allocation is a simple rule of thumb. Subtract your age from 100 to determine the percentage of your portfolio to allocate to stocks, with the remainder in bonds and cash. For example, a 30-year-old might have 70% in stocks and 30% in bonds and cash. This approach automatically reduces risk as you get older and closer to needing your money. While not perfect, it offers a straightforward starting point for many investors. Risk-based asset allocation focuses on dividing your portfolio based on the risk level of each asset class, rather than just expected returns. This approach aims to balance the overall risk, so no single asset dominates your portfolio's risk profile. It's especially useful for investors who want to avoid large losses during market downturns. By understanding the risk contribution of each asset, you can create a more resilient investment strategy. Goal-based asset allocation tailors your investment mix to specific financial objectives. For example, you might have one portfolio for retirement, another for a child's education, and a third for a major purchase. Each goal has its own time horizon and risk tolerance, so the asset allocation for each can be different. This personalized approach helps you stay focused and measure progress toward each goal separately. Global asset allocation involves spreading your investments across different countries and regions. This strategy can help reduce risk by diversifying away from a single economy or market. International stocks and bonds may perform differently than domestic ones, offering new opportunities and challenges. While global allocation can enhance diversification, it also introduces currency risk and other complexities. It's important to research and understand the global markets before investing internationally. Sector allocation is a strategy where you invest in specific sectors of the economy, such as technology, healthcare, or energy. By allocating a portion of your portfolio to different sectors, you can take advantage of trends or growth in certain industries. However, sector investing can also increase risk if one sector underperforms. Balancing sector exposure is key to maintaining diversification and managing risk. Balancing is the process of realigning your portfolio back to your target asset allocation. Over time, market movements can cause your portfolio to drift from its original mix. Regular rebalancing, whether annually, quarterly, or after significant market changes, helps you maintain your desired risk level and investment strategy. It's a disciplined way to buy low and sell high, keeping your portfolio on track. Diversification is a key principle of asset allocation. By spreading your investments across different asset classes, sectors, and regions, you reduce the impact of any single investment's poor performance. Diversification doesn't guarantee profits or protect against all losses, but it can help smooth out returns and lower overall risk. A well-diversified portfolio is the foundation of a sound investment strategy. In building your asset allocation, it's important to consider the costs and fees associated with different investments. High fees can eat into your returns over time. Look for low-cost index funds or ETFs to keep expenses down. Always read the fine print and understand how much you're paying for management, trading, and other services. Keeping costs low helps your investments grow faster. Taxes can have a big impact on your investment returns. Different asset classes are taxed in different ways, and where you hold your investments, taxable accounts versus tax-advantaged accounts matters too. Tax-efficient asset allocation means placing tax-inefficient assets like bonds in tax-advantaged accounts and holding stocks in taxable accounts. Consult with a tax advisor to optimize your asset allocation for tax efficiency. Investors are often influenced by emotions and biases, which can lead to poor asset allocation decisions. Common pitfalls include chasing recent winners, panic selling during downturns, or overconfidence. Being aware of these behavioral biases can help you stick to your asset allocation plan and avoid costly mistakes. Discipline and a long-term perspective are your best allies in successful investing. Inflation erodes the purchasing power of your money over time. When planning your asset allocation, it's important to include assets that can outpace inflation, such as stocks or real estate. Keeping too much in cash or low-yield investments can leave your portfolio vulnerable to rising prices. A well-balanced allocation helps protect your wealth from the effects of inflation. Trying to time the market buying and selling based on short-term predictions can be risky and often leads to low returns. Asset allocation strategies focus on long-term planning and discipline, rather than guessing market movements. By sticking to your allocation plan and rebalancing as needed, you can avoid the pitfalls of market timing and stay focused on your financial goals. Index funds are a popular tool for asset allocation. They offer broad market exposure, low costs, and diversification. By investing in index funds for each asset class, you can easily build a balanced portfolio that matches your desired allocation. Index funds are especially useful for investors who prefer a hands-off approach and want to minimize fees. Target date funds automatically adjust their asset allocation as you approach a specific retirement date. Early on, they invest more in stocks for growth, then gradually shift to bonds and cash for stability. These funds are a convenient option for investors who want a set-it-and-forget-it approach to asset allocation. Just choose a fund with a target date close to your expected retirement year. Robo-advisors are online platforms that use algorithms to create and manage your asset allocation automatically. They consider your risk tolerance, goals, and time horizon, then build a diversified portfolio for you. Robo-advisors are cost-effective and convenient, making them a great choice for investors who want professional management without high fees. No two investors are alike, so it's important to customize your asset allocation to fit your unique situation. Consider your age, income, financial goals, risk tolerance, and investment knowledge. There's no one-size-fits-all solution. By tailoring your allocation, you can build a portfolio that reflects your needs and helps you stay committed to your plan. Some common mistakes in asset allocation include neglecting to rebalance, chasing performance, ignoring fees, or failing to diversify. Avoiding these pitfalls can help you achieve better long-term results. Stay disciplined, review your allocation regularly, and make adjustments as your life circumstances change. Remember, successful investing is about consistency and patience. It's important to review your asset allocation periodically, at least once a year or after major life events. Changes in your goals, income, or risk tolerance may require adjustments to your portfolio. Regular reviews help ensure your investments remain aligned with your objectives and can adapt to changing circumstances. Major life events, such as marriage, having children, changing jobs, or retirement, can affect your financial goals and risk tolerance. When these changes occur, it's a good idea to revisit your asset allocation. Adjusting your portfolio ensures it continues to support your evolving needs and helps you stay on track toward your long-term objectives. Financial advisor can help you develop and maintain an asset allocation strategy tailored to your needs. Advisors offer expertise, objectivity, and support, especially during volatile markets. They can help you set realistic goals, assess your risk tolerance, and make informed decisions. If you're unsure where to start or need guidance, consider consulting a professional. Technology has made asset allocation easier than ever. Online tools, apps, and robo-advisors can help you assess your risk tolerance, set goals, and build diversified portfolios. These resources offer convenience and accessibility, allowing you to manage your investments from anywhere. Embracing technology can streamline your investment process and help you stay organized. Sustainable or ESG, environmental, social governance investing is gaining popularity. You can incorporate ESG criteria into your asset allocation by choosing funds or companies that align with your values. Sustainable investing allows you to pursue financial returns while supporting positive social and environmental outcomes. It's another way to personalize your investment strategy. Compounding is the process where your investment earnings generate their own earnings over time. A disciplined asset allocation strategy allows you to benefit from compounding by staying invested and reinvesting your returns. The longer you stick to your plan, the more powerful compounding becomes, helping you grow your wealth exponentially over the years. Stress testing involves simulating different market scenarios to see how your portfolio would perform under adverse conditions. This process helps you identify potential weaknesses in your asset allocation and make adjustments before real-world events impact your investments. Regular stress testing can give you peace of mind and improve your portfolio's resilience. Discipline is key to successful asset allocation. Markets will rise and fall, but sticking to your plan helps you avoid emotional decisions that can hurt your returns. Regularly review your allocation, rebalance as needed, and focus on your long-term goals. Remember, patience and consistency are your best tools for building wealth over time. Looking at historical market data can provide valuable insights into how different asset classes perform over time. While past performance doesn't guarantee future results, understanding history can help you set realistic expectations and build a more resilient asset allocation strategy. Learn from the past to make better decisions for your future. Markets are constantly evolving, and so should your asset allocation. Stay informed about economic trends, interest rates, and global events that could impact your investments. While it's important not to overreact to short-term noise, being flexible and willing to adjust your allocation when necessary can help you navigate changing market conditions. Asset allocation is a powerful tool for building wealth over the long term. By balancing risk and reward, staying diversified, and sticking to your plan, you can grow your investments steadily. Remember, wealth building is a marathon, not a sprint. Consistency, patience, and a sound asset allocation strategy are the keys to financial success. Let's recap what we've covered. Asset allocation is about dividing your investments among different asset classes to balance risk and reward. There are many strategies, from strategic and tactical to goal-based and global allocation. The right mix depends on your goals, risk tolerance, and time horizon. Regular reviews, discipline, and a focus on costs and taxes help you stay on track. With a solid asset allocation plan, you can navigate market ups and downs and work toward your financial goals. Thank you for joining us on this journey through asset allocation strategies. Remember, there's no perfect formula, but understanding the principles and tailoring your approach to your unique situation can make all the difference. Stay disciplined, keep learning, and revisit your plan as your life evolves. With the right asset allocation, you're well on your way to achieving your financial dreams.